Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hi everyone, my name is Michelle and welcome to Through the Noise podcast. This week has been one of the most eventful weeks year to date. We're seeing a clear policy divergence between the two major economies in the world, with the US Fed signaling 2 more rate hikes this year, while China's PBOC going the other way and doing easing. Developments such as Blinken's upcoming visits to China is also arousing investors' interest. So how should you be positioning your investments? With me here today, we have Daniel Lam, Head of Equity Strategy. So hi Daniel. One of the most pertinent questions, or rather perplexing questions from investors, is the strong outperformance in the US equities versus the Chinese equities. So how do you see that evolving going forward?
Thanks, Michelle. So, like I've been saying in the Cut to the Chase podcast, investors have been enjoying a comfort zone in US equities. The high valuation, interest rate sensitive technology stocks have been rallying, and US growth data has continued to be beating expectations. But in our opinion, the Fed's hawkish message this week may take some of the tailwind from this rally. So this further tightening by the Fed could lead to upward pressure on bond yields, which may act as a headwind against the US technology sector valuations. So this, together with potentially slowing US economic surprises, because the economic expectations have been revising upwards, making it harder to beat. This may lead to some very mild locking of profit from investors. So meanwhile, we see emerging green shoots in China equities. So of course, the market could arguably be past the sweet spot in the reopening trade. We have seen monetary policy easing this week. So this shows the authorities' determination to support China growth. Moreover, Blinken is visiting China, and this may provide the catalyst to soothe market concerns over US and China relations, at least for the short term. And of course, China equities remains cheap. They are trading at 36% PE discount versus global equities, which is at one standard deviation below its 15-year average.
Got it. So for now, let's stick to China and dig deeper. How did the surprise of PBOC's policy rate cut this week impact the CNH and also the China's bond yields?
Okay, so let's take a brief recap of what happened. The PBOC trimmed its 7-day repo rate, 3 tranches of standard lending facility rates, and 1-year medium-term lending facility rate by 10 bips each, and that released about 37 billion RMB of additional liquidity via medium-term loans. Now, we believe that this was a powerful signaling move, and this shows that there could be more rate cuts to come potentially. And the PBOC Governor Yi Gang has committed to more counter-cyclical adjustment earlier this month. Now, we may see a cut of long prime rate in next Tuesday's meeting, and there are also discussions about further property support packages. So add all this together, it shows that policymakers are quite willing to add stimulus to soothe growth concerns. So what are the effects of this? So these measures are likely to maintain downward pressure on China government bond yields, i.e. upward pressure on prices in the near term. Now, our preference within bonds is Asia US dollar bonds, and that can give investors an enjoyment of the growth benefit of policy stimulus. But over that, we continue to hold a strong preference for IG bonds within Asian dollar bonds. Of course, falling bond yields is a double-edged sword, and that means there could be downward pressure on the CNH in the near term. Of course, that's because of the less supportive rate differential. So technical indicators argue that a move towards 7.2490 remains possible before any potential retreat, i.e. before any potential strengthening in the CNH.
All right, so let's go back with the DM markets. So does the Fed's hawkish pause and the ECB's rate hike alter your near-term view on the US dollar and the euro?
Okay, so talking about FX now. So the Fed rate pause was in line with our expectations, but the forward guidance of 2 more rate hikes was more hawkish than anticipated. Despite all this, though, the DXY index has been dropping since the announcement. Whoa, so why is that? Well, because the ECB had got similarly hawkish guidance also, and they did hike interest rate by 25 bips. That's in line with ours and the market's expectation, and they've been guiding towards further rate hike, citing still elevated inflation. So this guidance supports our investment thesis that the ECB's tightening bias and Eurozone's declining inflation are likely to turn interest rate differential in favor of euro versus US dollar over the medium term. So that is our view of FX.
Got it. So the divergences in policies between the US and the China do seem to offer some potential interesting opportunities. So thanks so much, Daniel, for your sharing today. Please do stay tuned to our various publications and updates, and we wish you all a great weekend ahead.
Thank you very much.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.